Hi folks, Steve Nixon here at Logic FX Trading, and welcome to our building blocks series where we're learning Elliott wave theory as a prelude to the competent trader training and mentoring programs. In this third and final lesson on Elliott's guidelines, we'll take a look at what he called the right look and wave personality. We can see what he meant by the right look by the use of this diagram. You see, any 5-wave sequence can be forced into a 3-wave count by improper labeling. We've labelled it A, B, C, which gives us our A, then it's A, B, C, which gives us our B, and then we've got C coming up here. The correct way to label it is 1, 2, 3, A, B, C, giving us our 4, and 5, it's an impulse wave. In the jumble of live charts, it can be easy to mislabel it. So how do we go about avoiding this situation? Well, we know from the lessons we had on corrections that an A wave can have a 3 or a 5, but if it's a 3 then it's part of a flat correction, and therefore our B wave would come down here, would be a 3 wave down like that, and would come very close to the start of A, and then our C would come up something like this and break the top there, and then we'd get our continuation of our trend. So if you get a situation where you have 3 waves coming up, it's clearly mislabeled, and we need to relabel it as 1, 2, 3, A, B, C, our 4th correction, and then our 5. So that's what Elliott meant by the right look. You've got to look at it from an overall perspective and make sure that you're labelling it correctly. And we can do that by counting our waves and comparing it to the knowledge that we already have. Now naturally, as this is developing, sometimes it will be hard to tell exactly what's happening. But with experience, you'll understand that it's better to accept that for a period of time you actually don't know what's happening, rather than force it to be something that it potentially isn't. If you don't know where you are in the development of a wave or a structure, then it's best to just leave it alone for a while until you get more information and you can be a bit clearer on what's actually happening. This is a situation that can cause an awful lot of grief for inexperienced traders who know Elliott's rules but aren't experienced at identifying them and numbering them in live charts. Let's now have a look at what Elliott called wave personality. Now the purpose of this lesson is to make you aware of wave personality in general, and it's not meant as a comprehensive explanation of them. It's too early in the learning process for that. As I mentioned in the big picture, the charts are a mathematical or graphical representation of mass psychology. Essentially, they show us what value the market puts on any particular instrument at any given time. As such, they reflect the progression from pessimism to optimism and back again, and it tends to follow a similar path over and over. This wave personality is usually evident regardless of what degree of magnitude we're looking at. Now, they can benefit the trader by forewarning of what to expect next, and they can also help us determine at what point in the process we are, which is especially useful in situations where the count is unclear or ambiguous. This is because there are times when several different wave counts are correct under Elliott's rules, so understanding the wave personality can be invaluable in analysing the situation. Sometimes identifying a single wave by its personality can be the key to unlocking the complexities of a larger structure. So let's have a look at the personalities Elliott described for each wave in a complete cycle. We'll use this generic bull trend and correction for our description of the wave personalities, but just like everything else we've talked about now, they're equally valid in the bear market or a short trend as well. So let's start with our wave 1. Now approximately half of all first waves are deeply retraced back close to their origin. They can come right back down here, and they're the cause of what we call a double bottom. If we go back to this situation, as this was developing, traders may have analysed this as a wave 1, but when it retraced right back down to its origin, it became part of the basing process and isn't, therefore, part of our impulse. The other half of first waves rise from large bases or areas of extreme compression. Now these waves are dynamic and moderately retraced. In other words, depending on what's happening over here, this wave will either retrace very deeply or it will have a shallow retracement and then we'll move into wave 3. The importance of this from a trading point of view is if we've identified a wave 1, or even if we've identified this, be aware that they can completely retrace themselves, and therefore it might be a good idea to take profit in a wave 1 and wait until we get the start of wave 3 before we get back in again. Okay, so we've discussed wave 1 and 2, so let's have a look at 3. Third waves are a trader's dream. They're strong and dynamic and they leave us with no doubt that the trend is established. They often produce high volume and high price movement and are the most likely wave to be extended. As such, they're the waves that you don't want to miss. They'll more than make up for any losses made earlier in the process. As we've already seen, the correction depth of wave 4 is predictable, and because of alternation, we at least know that the structure will probably differ from that of the second wave. They're often complex corrections, which build a base for wave 5. So alternation tells us if this is a deep zigzag, then the chances are this will be a triangle or a flat. So we're already increasing our probability of correctly analysing wave 4. Generally speaking, fifth waves are less dynamic than third waves, unless they're extended by over-optimism. As we've seen, the stronger a fifth wave is, the more likely it is to produce a steep correction. Let's now have a look at our corrective waves. Wave A is often mistaken as a pullback before the next leg of an advance, and this results in traders buying at the bottom, which produces our wave B. Now, as we've already seen, the important lesson here can be found in the wave count. When A is developing, if it's a 5 wave, we know it's not finished, because a 5 wave is part of a zigzag, and as we know, zigzags have a tendency to look like that. So if we have 5 waves here, B is going to be short, and then we're going to get a C that comes down below A. If A only contains 3 waves, then there's a high probability that B will at least completely retrace back to the start of A, and as we've seen before, it can even go beyond it when we have an expanding flat or a running flat. Elliott described B waves as phonies, in that the market thinks that the A waves have pulled back and now price is returning to trend. But as you know, B waves are nearly always blown out of the water by a C wave or an X wave in a more complex structure. Now our C waves here are third waves. Just like a third wave in an impulse, they tend to be very dramatic and will completely wipe out any profits made while trying to trade B. Now in order to have a look at D wave, we're going to have to change this to a triangle. So let's take that out and we'll put in some form of triangle, A, B, C, D, E. And of course our C wave in the triangle doesn't completely retrace B. Our D wave is a hybrid in that they indicate a balance between the bulls and the bears. Remember, triangles are generally seen as a horizontal movement which buys up time while the market decides what's going to happen next. Of course, the one situation where what I've been saying doesn't work is where we're talking about an expanding triangle. E waves are ending waves and have a similar emotional fingerprint as a fifth wave. In this case, they indicate the end of a corrective phase, and we can expect a breakout, but be careful because they have a tendency to break out in the opposite direction just prior to the new trend. So in other words, if our trend was going to continue on up there, the E waves have a tendency just to spike down before they go up there, and it catches a lot of people out because they break out of the structure, giving people the impression that they're going short when in actual fact they're about to go long. Now these wave personalities are suggestive, and therefore they fall under Elliott's guidelines and not his rules. Remember, technical analysis is probabilistic and not exact science. We're dealing with probability here, guys. Nevertheless, wave personalities are a great tool for identifying individual waves where the wave count is ambiguous. Okay folks, once we get into the more advanced lessons of the competent trader, we'll look at this again in much greater detail, in particular how to trade them. Now that's probably enough information for one day, so we'll end it there and we'll pick up the story again in the next video, where we'll look at Fibonacci numbers and how they can be used to accurately measure ratios between waves, providing another valuable tool for our analysis. I'm Stephen Nixon. Thank you for watching. Bye for now.